Let's get a view of what is happening globally. Rajeev Malik, one of the most respected names, he's senior economist with CLSA, joins me on the phone line from Singapore. Thank you so much for joining us, Mr. Malik. Let me start off with the event that's lined up tonight. How important is it going to be, the debate between Trump and Hillary? And if Trump actually scores a few points, you see more voter registration, he goes up, maybe takes a lead in the polls. What happens?
Well, I mean, this is, first of a few debates, so we just have to wait and see how it pans out. And don't forget, in any case, he's been narrowing the gap, and in fact, most of the polls seem to be a bit more favorable. I think markets, of course, are going to watch what is going to be perhaps the most widely watched debate, not just for content, but also for any potential theatrics that necessarily come about. I think it's still an evolving situation. We just have to wait and see, hope for the best, be prepared for the worst.
All right, what do you mean by hope for the best and be prepared for the worst? Because I think a lot of viewers in India want to understand the global investor mind.
I think there are two aspects. Whatever Trump has been indicating is hardly conducive from a global growth, global trade cycle perspective. So initially, of course, any kind of edging out that he creates will, raise concerns about any kind of a negative impact on that. It is, of course, anybody's guess, even if he were to win and be in the driver's seat, if he's necessarily going to follow through with all of the stuff that he's necessarily indicated. I do want to emphasize that India, interestingly, is still in a bit of a better position, because anything in case of a Trump win will be negative from a global trade perspective. And while all countries will obviously get impacted, countries which have a lower exposure to global trade will get impacted less, and India clearly isn't one of those. IT as a sector is, of course, an exception, but most of the others are really domestically driven stories where more constructive policy by the government could actually offer even further, decoupling of sorts.
Mr. Malik, I'm going to come back to India a little bit, but just to continue to focus a little bit on Trump, it's rare that a presidential candidate actually starts attacking the Fed. And we've seen how the Trump campaign has been saying that the reason why the Fed is not raising interest rates is because it's being driven by Obama, by Hillary, and is pro-Wall Street, pro-equities, and is taking money out of pensioners and small savers. If he starts to actually take a lead, will the Fed come under pressure to perhaps bring forward its interest rate, interest rate cycle a little bit?
I would be surprised. I mean, the Fed has had a well-established pattern of not necessarily being swayed by politics. And while you're right, it's perhaps for the first time that a presidential candidate has directly attacked the Fed. But then this has been an election cycle with many firsts. Thanks very much to Mr. Trump.
Do you, as an economist, someone who watches the global economy, do you see the rise of Trump, and if there's an ultimate Trump victory, do you see that as a beginning of a change in global politics, in the sense that countries will become more inward-looking and there will be curbs on fund flows, curbs on finance capital?
Well, I mean, the first part, in a way, of what you suggested is already happening in different geographies for different reasons. All of them really catering towards the local dynamics, political, social, economic. Whether that would necessarily translate into, beginning to restrict capital flows, etc. It's a scary thought, and one that we'll just have to wait and see how the situation evolves. Don't forget, what you don't want to get into is a situation where what one country thinks is good for it actually lands up being bad for everyone at large. That really is a lose-lose proposition. And while, gains from trade and globalization might have been uneven, but they were generally positive, spin-offs. So really the idea is not to reverse them altogether, but to really have them better targeted and better outcomes.
The reason why I'm asking is that I heard you say that India is in a sense decoupled for the global trade, not the global economy, But if, let's say, Trump or any such movements take place, like let's say what we saw, that there was a sense that Corbyn might lose the Labour internal elections. He's actually come back with more votes. Younger people have actually voted him back into power. If there are curbs, as I mentioned, if there is a curb on global trade, if the US starts putting curbs on Chinese imports, then the entire commodity cycle, which was picking up again, that could again see a downward trend, which would affect India as well.
It would, but again, I come back. I mean, the idea is not that here is a $2 trillion economy that has been establishing greater linkages with the rest of the world, that anything that positive happens, India will benefit, but anything negative that happens, India somehow will be unaffected. That really can't be there. All I was trying to highlight was anything that is negative for global trade will impact all countries. The proportion of how they're impacted would be a function of how much exposed they are. So clearly, a direct impact, if Trump were to have on China, would be far more pronounced for that and some of the other East Asian economies than necessarily for India. That doesn't mean that India won't be impacted, but after that initial panic reaction, as typically happens, there would be greater amount of differentiation that people will try and pinpoint. And it is not as if that investment dollars would not be flowing. They'll be more selective and more targeted.
And in that selection and targeting, you think that India is actually the most, would emerge as the preferred destination?
Well, not the only one. I think one of the things India and Indian policymakers and investors investing in India have to realize is that it's not necessarily the only game in town. Indonesia, a fair amount of good stuff has been happening there. Their interest rate cycle actually has more ways to go in terms of lowering rates, and that certainly keeps interest as far as investors are concerned. At a very smaller level, you have Philippines and Vietnam, which are very much on the radar as far as investors are concerned. Smaller from a liquidity perspective, but nevertheless, India should be using these opportunities to strengthen its reform credentials as it has been, because that will just create more and more differentiation in its favor.
You mentioned the interest rate cycle. Indonesia appears to be likely to better place to cut interest rates. Do you think that India will see lower interest rates this year and the next year?
Well, it most likely will see lower rates this year. From a policy rate perspective, I mean, we do think there are strong grounds for either the governor or the MPC, if it is operational by the next policy meeting next week, to actually come through with a 0.25 percentage point rate cut. I don't think there's significantly more room, simply because we need to get that medium-term inflation down. I think one of the debates that's everlasting in India is this whole issue about lowering inflation, and it is important, and there are very good case studies. Philippines, Indonesia are good cases in point, where you have to get trend inflation down, which then opens up scope for a structural decline in interest rates, which can be a welcome kicker as far as growth dynamics are concerned. In the absence of that, any kind of policy adventurism that some like to advocate, I think is really somewhat self-defeating.
Okay, one of the stories in India a lot of people are talking about is a credit-driven consumption boom. Part of it, of course, is the 7th Pay Commission, state pay commissions will come into play, monsoon having some sort of an effect on rural consumption, but also a credit-driven consumption boom because banks have nowhere else to lend to. My question is, if that is going to take place and no new capacity is coming in, why would we think that consumer inflation is going to go down except for food price inflation?
Well, again, I think it's important to bear in mind nobody's talking about a trend decline over the next 12 months. That is where the much harder work for the government remains to be seen. We've had a good inflation trend, purely lower inflation. Food inflation will drive it lower, and RBI's 5% target for early 2017 is very much achievable. In fact, the outcome could even be slightly lower than that. I think the fight is really going to be, or the challenge is going to be going from 5% to 4%, simply because structural rigidities begin to assert themselves. And even though we've had welcome softening in food inflation, I don't think India has really put together institutional mechanism whereby the very high volatility in food inflation has actually been fixed forever. So, every few months you go through exogenous shocks that pretty much upset the inflation calculation. The point you raised about, private consumption being the sole driver, especially in what is a largely supply-constrained economy, is a valid one. And eventually that will begin to exert pricing power as far as corporates are concerned. But given where we are with the amount of excess capacity in the system, it will take some time. The only thing is central banks, and RBI very much is included in this, have a much longer time horizon than typical investor. So they would be very much mindful of some of these pressure points, and therefore scope for a significant easing in rates is unlikely. I mean, I only expect one rate cut, October, if not October, then December. But that's about it. I think people have to be mindful of how we get to that 4% target, and that doesn't necessarily mean it's at the expense of growth. But achieving 4% does open up room for significant monetary easing, which interestingly will be positive for growth.
Mr. Malik, let me just pick your brains on and break up that consumption story that everyone's talking about, that investment cycle has still not picked up and consumption is what is going to drive growth in the next couple of years or so. As I said, that we aren't really seeing dramatic improvement in employment numbers. At least white-collar urban employment is not going up. It could actually go down if IT faces a problem. It's not as if people are getting huge raises. The impact of monsoon, whenever there's been a good monsoon on rural incomes, has been variable. It doesn't always generate high rural income. Sometimes farmers tend to fix their balance sheet first. So other than the government sector pushing out some amount of consumption, where of course there's a concern about housing, HRA pushing up CPI as well, but other than that, it will have to be credit driven, right?
Well, I mean, it has to be a combination. I actually think the whole HRA angle on CPI inflation tends to be played up way too much. It's a mechanical adjustment, and quite frankly, the central bank should see through it, unless, of course, things are so hot from a demand perspective that it begins to risk second-round effects. But your broader point that, look, it is still a consumption-driven growth cycle, it's there. We really can't change a whole lot, and this is where it's important to realize that it is not so much that rates are keeping growth down. I mean, if you just look at the profile of credit growth of private banks versus public sector banks, you will realize that one is able to extend credit at a faster pace simply because their balance sheets are not as bad as the other category. So, growth is growth, and the question really is about how to manage that evolving transition, and that is where the investment cycle will take some time. I actually remain puzzled that, everyone wants the investment cycle to turn around quickly, and interestingly enough, at least in the framework we've had for the last year and a half for India, investment cycle will actually be the last piece that falls into India's growth story.
No, I just wanted to break up that consumption. I understand what you're saying, that growth is growth and consumption has to drive it for some time. I'm just saying that there are no jobs, there are no new jobs. It's not as if people are getting huge raises. It's not as if new entrepreneurs are coming up. It's not as if small shops are opening up. It's not as if there is increasing consumption from earnings, from cash flow perspective. It has to be from debt, and that's what I'm asking you. Are you happy with that? Is that sustainable? Well,
it's not a question of happy or not. Would I prefer a much broad-based recovery? Absolutely. But I think one also needs to appreciate and realize that for exactly the reasons that you're highlighting, one is not talking about inflation, going through the roof or the economy overheating. At any phase in the economic cycle, the pluses and minuses have a certain impact, and that has to be digested. You are right that given the level of growth India has, employment generation is weaker. But don't forget, this is being said with really no good handle on what's exactly happening in the labor market, especially as far as the informal sector is concerned. And you also have to put it in context in terms of the broader global downshift as far as manufacturing itself is concerned. So is it the best possible situation? No, but it is better than not having any kind of pickup in consumption? Absolutely.
So are you seeing lumpy growth over the next few years? Are there going to be ups and downs? Or is this the beginning of a secular cycle of increasing growth for India?
Well, I mean, India is on a structural footing. Near term is going to be pretty gradual, uneven, and that's just a combination of domestic and external headwinds that have to be digested. But even if you do away with the level of growth that the official GDP numbers seem to be suggesting, the sequential improvement gradually will still play out, and I think that's the important aspect. We are past the weakest point in the cycle. Everything is far from hunky-dory. But we are certainly better off than many other places, and there is immense scope to actually strengthen that structural story. And that, that's saying a lot.
One final question, Mr. Malik, and that is about India's GDP data. Now, the governor, RBI governor, as has been reported in the newspapers, has said that he is not entirely convinced with the data, but at least it's better than what it was earlier. Are you on the same page?
Well, I mean, every GDP revision makes for better quality. I think the critical issue with the latest set of numbers that India has announced is whether there's some kind of a fault as far as the GDP deflator is being used. Reported real GDP growth is higher than what it feels on the ground, what a lot of corporate feedback, bottom-up indications would suggest. I don't think it's a case that somebody is actively rigging the number. That probably can't happen in India. But really, on the ground growth momentum, if you were to say, a real test is not really what the real GDP number indicates, which is why I mentioned earlier, the important thing is to see what the sequential direction is, even if the level of growth is questioned.
So are you using any other indicators at CLSA? Have you got other setups to gauge what is happening on the ground?
No, I think it's quite fashionable to pick up, limited areas, any kind of widget that's selling well, and to create a proxy GDP series. I think for doing that for a $2 trillion economy is full of questions. Don't also forget that this $2 trillion economy has quite a few uneven growth parameters. So if you look at what's happening to oil demand, for example, oil consumption, it's actually been far stronger than what the industrial numbers would suggest. If you look at indirect tax collection, they have actually been much better than what just activity indicators would suggest. My sense remains that, at one extreme, the official real GDP numbers tend to overstate the underlying growth momentum. At the other extreme, the official industrial production numbers tend to underestimate it. So the reality is somewhere in the middle, although it's a wide middle, I confess.
I did say it was the final question, but I have one final question. Singapore has often been a barometer of what is happening globally. If Singapore is doing well, you get a sense as to global trade, global growth. Sitting in Singapore, what are you sensing?
You're right. I mean, I've always seen Singapore as a warrant on global growth. And if you were to use it as a temperature stick, there's really not much happening as far as global trade dynamics are concerned. And, the broader growth momentum here certainly captures that. So the broader hunt for yield continues to play given the strong liquidity backdrop and, of course, still real weak growth momentum globally.
All right, Rajeev Malik, thank you so much for taking us time for us. Pleasure talking to you.
Thank you.